the taxes! What are the taxes?
Holy smoly! $20.71 before taxes, man. What's it made out of gold?
It's tax 2246.
22.46.
How in the hell does that have to do with paying my taxes?
The tax and responsibility of babysitting entitled students.
I don't care who the IRS is, I am not paying taxes.
Is everything okay? You okay?
I'm great, Eunice. I'm just trying to figure out what I should charge Canadians. High rates, low rates, extremely high taxes like Zoran Mandani on the rich. I'm trying hard to figure out what I should charge. As the tax god, the purveyor of the income tax, it's on me to decide what Canadians will pay. Excuse me, we have a question for you. What do you think the income taxes should be like in Canada? Rates, should we be like Mandani in New York? What should we do? Tax the rich, tax the poor, what should we do?
Je pense que ça devrait être comme Mamdani à New York, plus haut. Mais je pense qu'on est quand même déjà bien, là. On fait donc bien ça, je pense.
Je serais d'accord. We should have a progressive tax system, but that's what we have already. Maybe it should be progressive. I don't know.
Tax the 1%. Yeah.
There we go. Coming back to you live in studio. Fair tax. A question as old as the government itself. Adam Smith believed we ought to contribute in proportion to our respective abilities. A noble, almost quaint idea. But in the cold, hard reality of the Income Tax Act, this principle twists into something far more complex, a far more grim. Our journey begins not with hope, but with the inevitable structure of burden sharing, the progressive tax system. Section 117 of the Income Tax Act lays out the tiers, a ladder of obligation, 14.5% of the first portion of your income, 20.5% on the next, 26, then 29, climbing to a peak of 33%. These brackets, adjusted annually by the cold mechanical formula of section 117.1. A reminder that your financial ascent is met with a heavier load. This is the law's acknowledgement of the ability to pay. But this is actually only the surface. In 1966, the Carter Commission delivered its report. It was supposed to be a pragmatic exercise, but against its own pro-business composition, it stumbled into a dark truth. The Commission concluded that taxation is not merely a technical necessity, it's an inescapable matter of justice. The report on the Royal Commission of Taxation declared that if we tax, we also must justify. And a tax just requires a comprehensive base. Every accretion to wealth, every single dollar. This led to the most controversial, and some would say the most purely philosophical statement in Canadian tax policy. A buck is a buck. A dollar from hard labor and a dollar from a fortunate stock sale bestow the same economic power. To exclude one is a gross injustice.
To say that you're fine when you're not really fine, but you just can't get into it because they would never understand.
But this radical clarity was too bright for the political world to bear. It was compromised. And so we descend into the gloomiest, most uncertain part of our system, the taxation of capital gains.
Once you start, there's no going back.
The Income Tax Act sections 39 and 54 give us the tools, but not the light. Section 39.1 defines a capital gain by what it is not. A gain that isn't ordinary income, a definition of negatives and exceptions, a circular darkness. The owed adjusted cost base half measure, a ghost of the Carter Principle. The ITA does not provide a clear mechanical test. The key question is the following. Was the property held on account of capital or an investment? Or was it part of an adventure in the nature of trade or business inventory? This is a desperate struggle to classify gains as capital and losses as business, because the consequences are a chasm of difference. But why the compromise? Why do we treat this dollar differently? Conceptually, a capital gain is not like a salary. It's not a payment for an ongoing effort. It is an accumulated appreciation, phantom wealth that has grown, untaxed, over the entire holding period. On a paper gain, unrealized until the moment of sale. Conversely, capital loss is an accumulated reduction in the value. A silent loss is actually not accounted for until it's made final. This creates a fundamental distinction. The income from holding the asset, rent, dividends, is a steady stream, taxed as it flows. But the gain from dispossessing of the asset itself is a sudden, lump sum realization of years of accrued economic power. The system offers a grim bargain, the 50% inclusion rate. You only tax half of the gain, a tacit acknowledgement of this accrued phantom growth, and a political concession to the power of capital. It's a half measure, a ghost of the Carter Principle. Steps the courts. The precedent was set in a case that would cast a long, dark shadow over every property transaction for a decade to come. Regal Heights Limited versus MNR. This was not a case decided in a swift, single judgment. It was a grim march through the appeals process. It began with the Minister of National Revenue. The minister assessed the gain from the sale of the land as income, a business venture. This was the first blow. The taxpayer, Regal Heights, appealed this assessment to the Tax Appeal Board. They fought for the characterization of the gain as a capital receipt, a mere realization of an investment. But the board upheld the minister's assessment, and the appeal ended up being dismissed. The darkness deepened. Regal Heights pressed on, appealing again, this time to the Exchequer Court. Yet again, they met defeat. The judge there found the transaction was indeed an adventure in the nature of trade. The gain was business income. The two courts had now spoken against them. Finally, a last desperate appeal to the highest court in the land, the Supreme Court of Canada. But there was no salvation there, only finality. The Supreme Court dismissed the appeal, agreeing with the courts below.
The Supreme Court judgment in Regal Heights solidified a doctrine of profound uncertainty. The court acknowledged the taxpayer's primary intention might have been to develop a shopping mall, but it found a secondary intention to sell the land at a profit if the right opportunity arose. For the court, the secondary profit-seeking motive was sufficient. It was enough to taint the entire venture, to recast the hoped-for capital gain as a business income. The precedent was set. A taxpayer's fate could hinge not on their main plan, but on a shadowy alternative motive that the court could unearth and hold against them years after the fact.
This shadow was cast forward decades later. In the 2022 Quebec Court of Appeal case, Immeuble Zamora Limité, the ghost of Regal Heights haunted this partnership. They had built and operated a residence for the elderly, but the revenue agency reclassified the gain on its sale. The Quebec Court of Appeal affirmed this, noting that the trial judge's findings of a secondary intention was not a manifest and overriding error. The subjective, hindsight-laden test from Regal Heights lived on, proving that no transaction is ever truly safe from reinterpretation. So we're left in the gloom. We tax capital gains because justice, as defined by the Carter Commission, it demands it. But we tax them preferentially, a betrayal of that same principle, and we force taxpayers and the state into a perpetual, costly war in the dark corridors of intention. A war defined by the bleak procedural history and final defeat in cases like Regal Heights. The system is a monument to a compromised ideal, a grim reminder that tax law, the pursuit of justice, is often shrouded in a shadow, and the only certainty is the burden itself. Oh my God, my lord. I didn't know that you were here today.
You thought that you could get away, but you failed to appreciate that I've been waiting for this moment.
My lord, please. We can fix the tax system together. We don't have to do anything righteous or quick. Please, my lord, let's work together.
I have given you chances. Now I must make a sacrifice.
My lord.
This is Sparta! The tax system will carry on